let's try and understand what's really happening within the entire consumption space. What's the way forward? We've got Jignanshu Gor, Director and Senior Research Analyst at Bernstein India, joining in on the show right now. Jignanshu, hi, great to have you today on ET Now. Since the retail category is so large, and I was just going through your note, let's break it up one by one. And let's firstly start off with the traditional brick and mortar retail models, which have gotten, in their own words, pretty hard hit by QCOM. What do you think lies ahead for them?
Thank you so much for having me on the show, first of all. Uh, the entire retail landscape, I think, is going through a churn, right? This churn or this energy is not the first time. The first time that we saw this churn was way back in the 2000s when modern trade first started, and then in the 2010s when e-commerce started, along her e-commerce, and now with quick commerce. We think this churn will also go. It will there is a end to this churn as well. But in the short term, it will change the landscape. I think for consumers in India across price bands, if you can deliver products at this price points to their doorstep, there is going to be gradual take up. Whether the take up is as fast as we saw the take up in food delivery, let's say post COVID, or whether the take up is a little bit more gradual for retailers, especially grocery and apparel, is something that remains to be seen. There is a in a Given the dynamics of India as a market, I think the future it will be a combination of quick commerce, some part of long haul e-commerce, and brick and mortar retail. And brick and mortar again split into possibly modern trade and kirana stores. I think the consumption segment in India, like you rightly said, is large, both from size but also from the number of archetypes of consumers. So there are consumers who will opt for convenience over value. There are consumers who will want value, especially when it comes to essential items like groceries. And hence, value retailers who consistently communicate that to the consumer will win, especially in times of, and I was listening to Mr. Murarka as well, in times of slightly weaker prospect of consumer demand like we are in today.
That is the story. Value, which is Sasta Sundar Tukau, should do well when inflation is high. Simple. But DMart numbers are not strong.
Yeah.
I'm not talking about last quarter. I'm talking about last 1 year, when value retail should have done well because you want to conserve more, you want to save more. Rural India was hit by inflation. Semi-urban India was hit by inflation. You and me are feeling the pinch of inflation. Everybody's feeling the pinch of inflation. Yet value retail has suffered. Why is that?
So I think DMart is one part of the story where on grocery, their largest challenge has been that almost 65% of their revenues comes from only the top 40 cities. Now, there the largest challenge to DMart, as they have acknowledged themselves, is the shift in channel, which means temporarily, given the challenges on inflation, the number of consumers who would buy from local kirana stores and buy loose goods, they shifting to DMart is DMart's story, right? So if you look at the pyramid, there is a middle of the pyramid that DMart targets. Whether consumers coming in from the bottom to that sliver are higher than the consumers who are going out of that to seek more convenience. For the short term duration, DMart has had that challenge in metro cities where the deep discounting plus convenience done by quick commerce players has hurt them. The same store sales growth, though, dipped to a minimum of 5.5%, which by DMart standards is low. I think the other challenge that DMart has is its network growth has not been up to their own standards. So in the last few quarters, they came down to 11%, 10% revenue network growth versus their own stated objective of reaching close to 14 to 15%. So I think a combination of these two has impacted their performance, and then the operating leverage flows that down to EBITDA and margins as well. The way forward, one, they need to improve the e-commerce game, because I think consumers, once they get a taste of convenience, especially consumers for whom grocery item is not a large part of their expenditure bucket, will move to convenience, and DMart needs to have that defensive play. Second, I think they need to accelerate store openings. They have bought a lot of land, and their land acquisition costs have gone up materially in 2023 and 24. But we are yet to see the stores corresponding to those lands come back. So once those two things happen, and now interestingly coupled by the new CEO and what kind of narrative he lays out for the company going forward. So I think these are the three stock triggers for demand. Two of them are performance triggers. One of them is a narrative trigger.
Quite interesting. But Jignanshu, the other end of the curve is obviously QCOM, and let's pick up on a Zomato, for instance, right? Now, various businesses in there, and let's talk about Blinkit first, because what they're saying is categorically they are seeing some slowdown, cash burn, expansion, all of it for the next 1.5 odd years. Having said that, even the food delivery business is where they're talking about a demand slowdown, quote unquote. And yeah, the business they picked up from Paytm, that's going to obviously take some, time to actually turn around, District that is. But traditionally in the Blinkit story, because that is what ascribes Zomato the kind of valuations that it cherished when it hit 300 plus, right? Where do you think that piece of the puzzle is going to head, given the fierce competition now within this space?
So I think since Zomato is covered by my colleague Rahul, let me talk about the overall consumer landscape and where I think the play for quick commerce versus modern retail exists. I think there is a segment of population for whom convenience matters. And the play forward for quick commerce players, anyone from a strategy perspective, whether it be Zomato or whether it be others, would be to get an increasingly higher share of wallet from these customers. Today, I think there is a land grab phase with multiple competition going on, and I think the that land grab phase will continue till investors demand returns and sanity versus growth, right? So I think that balance, for example, 5 years ago shifted for food delivery. When the market started, you had a lot of competitors, and then there was consolidation or there was natural selection. I think that will happen for quick commerce as well. uh, the It's not a winner take all market, but the market cannot also sustain 10 competitors or even 7 competitors. So I think the way ahead is consolidation, and I think strategically it makes sense to do land grab, especially if you have cash on the balance sheet. I think the other interesting read across, though, like you mentioned, from Zomato results is on restaurant or QSR numbers. In the context of their food delivery business, Zomato referenced consumer slowdown. But if you look at the QSR numbers, the consumer slowdown was visible in Jubilant and Devyani and Westlife 4 quarters ago. So why the dichotomy? I think the way to think about it is, if you look at Zomato and you look at the order value that they generate for every restaurant that they have, I think that order value has been degrowing in the last 2 quarters, and it degrew by 4%, which means that an average restaurant on Zomato is really feeling the pinch of consumer slowdown. Right? This is now seems to be turning around for at least Domino's, which I think is backed by strong execution. So when demand slowdown happens, you typically back businesses which have good capital allocation and great execution. And I think Zomato has proven that on food delivery in the past. And from a QSR perspective, I think Jubilant is one of the best placed to benefit from the delivery growth and to showcase the execution capabilities that they have.
It's so counterintuitive. It's like saying in Hindi, if I may say, vada pav nahi bik raha hai, magar pizza bik raha hai, right?
No.
Yeah, Jubilant Foodworks is
Pizza
pizza.
khane wale are going to vada pav. I mean, if you were to take the analogy, you're downsizing and downtrading your order value.
Yeah.
Right, Jignanshu?
Yes,
Yeah.
yes, absolutely. And in fact, which is why if you look at what menu innovation every QSR company has done in the last 12 months, it has been on value, it has been on 2-pack combos and 3-pack combos. Because they realize that the only way for them to create a secular growth story for QSRs in India is to bring the vada pav eaters and the roll eaters and the biryani eaters into the pizza and the burger category. Unless they do that, and they try to compete at that price point, their growth will remain question mark. So I don't think it's a dichotomy. In fact, interestingly, Nikunj, the same dichotomy somebody mentioned to me that consumers are buying premium products. So Uniqlo is growing very well. People are buying sports products because Decathlon is growing very well, but Demart is not growing, right? And Aditya Birla is not growing. And my answer was that consumers are saving where they can on staples and using that money to go to Zudio, right? So I have met consumers who go to a DMart, make the pain of going to a DMart to save that 1,000 rupees on their basket because that is their budget for uh, beauty parlor for the month.
Get that. But then, what does it mean for Trent? Because it has sort of all ends of the curve, covered, right? It has a Trent, I mean, it has a Zara, Inditex, and it also has a Zudio and West Side.
Yes. See, again, I think they are, the good part about Trent is they don't house different price points in the same department store. Because from a consumer perspective, especially in tough times, consumers fear wallet inflation when they go for shopping. So brands which are very particular about their price points attract those customers because they don't want to go in with an expectation of spending X and eventually spending 2X or 3X. So which is why I think Zudio has done really well. It has benefited from the aspiration segment who does not have money to spend but wants to move in from a linking road price point and linking road experience to the same price point but a boutique experience. I think that's the market that Zudio has captured. They have again in quarter three, as per publicly available data, added almost 40% YOY square feet, retail square feet, which bodes very well for their growth potential. I believe Zara is the same, though their store expansion is something which has suffered given the ownership, the question marks and challenges between Inditex and Star. In fact, there has been a buyback that Inditex has done from Trent for some of the Zara shares. But they again are very well price point wise placed, completely different segment versus what Zudio is. I think in this market, we can expect Westlife to struggle a little while festive seasons help, but in general, uh, brands or department store formats for apparel are something which will struggle when the times are tough because consumers do end up down trading, let's say to a Zudio in the case of Trend. But the good part about Trend is they can capture that. I think the challenge for Trend is having this treadmill of 35 to 45% growth and continuing that. And if they can prove that for the next couple of quarters, I think it's a fantastic execution story for India. And they can be the largest apparel brand in India by far.
But it's one of the most expensive ones as well, right? So are you now reworking your price targets? I was just noticing it's already sub 5,700 now.
Yes, I think that's largely due to broad slowdown. But as I said, in these kind of markets, you look for companies which are potential market leaders in their space who have the execution rigor and who have the discipline for capital allocation. And I think all these three is where Trend sort of ticks the boxes for me. Uh, the question is, can it become 15,000, right? And which means can it give a 18% CAGR? And what does it mean to be that number, let's say in 2030, right? So I think that's the way to think about structural stories versus thinking about a QSR companies, which for me right now are more cyclical stories. So when I look at Trent, I see a structural story in that it can become a 3-4% share of apparel market in India, which will lead it to having close to 12 to 15,000 rupees of effective share price from now, and which gives you a 15 to 18% CAGR as well from now till 2030. And hence, I think it's a great price point to enter if you're looking to enter a structural story in India right now.
Let's look at 3 years out. Where do you see a combination of earnings growth but no return? Like earnings will grow, but the P multiples are so bloated that the returns may not there. That's part one. Part two, where do you see a combination of earnings return, which is earnings will grow at 15-18%, the stock will grow at that. And part three, the most interesting part, where do you see a combination of earnings growth and P multiple, which makes a multi-bagger or which makes a outperformer?
Yeah. So I think in consumer India, the unfortunate reality is the correction in most of the stocks happens because of downgrades, not because of multiple re-rating. Because multiple re-rating means you have to assume that the story for consumption in India is in question mark. And either on the buy side or the sell side, I haven't seen that narrative yet. So until that narrative comes, Nikunj, it's very difficult to find stocks in the third bucket, especially some of the larger stocks which we cover. You might be able to find uh, undiscovered micro mid caps, which might be there. Maybe Trent was there 3 years ago. Undiscovered stock, multiple re-rating. Uh, Now, in the first case, I believe there are you will find returns difficult from a 3 year perspective in somebody who is anywhere above 80, like 70, 80 P, which many consumer stocks are, where you will find earnings growth but no returns for investors. I believe that at these price points, both DMart and Trend should be in that middle bucket, where you will not see earnings, you will not see a PE re-rating, but growth should help get close to 15 to 18% returns for stakeholders in a 3 to 4 year time frame. So that's how I would bucket it. I think from my coverage again, Aditya Birla is the biggest uh, undiscovered story. There is overall a lack of conviction in their ability to transform the business since what we've seen in the last 5 to 7 years. They have the potential to surprise if they get their act right.
Interesting. And where does BPC fit into the entire piece, Jignanshu, right now? Because, I mean, if there is any saving or, purchasing power increases, that's all going to go into the BPC segment. That's your first port of call, right?
Yeah. So I think BPC segment is very challenging to build brands there, which are very large, because in general, I have a view that channels in India over the next 5 years will outperform brand growth in India, because disruption in channel takes away the powers that brand has, right? So unless you have both channel and brand, it's very difficult to consistently make money. BPC as a segment should outgrow most other segments in India over the next 5 to 7 years. Definitely apparel, which has remained steady to degrowth, or grocery, which largely grows with income and GDP. With BPC growth, though, the challenge is finding winners because it does not automatically translate into earnings potential unless you have own established channels for the BPC. The second thing which has happened in BPC especially is large companies earlier had an advantage of product development, manufacturing, and distribution. All those three advantages are being disintermediated right now with channels like quick commerce, modern trade, e-commerce really growing, with contract manufacturing for low MOQ products becoming very easy, and hence allowing brands like Zudio, who have their own channels, to add 100, 200 square feet through their stores and put a lot of beauty products and keep deepening that beauty SKU list as well. So companies who have their channels and can successfully expand adjacency from apparel or fashion to beauty can probably grow much bigger and faster than somebody who wants to roll out beauty products without a channel.
So this is Shrishti also joining in. While we did get your point on some of these names like Trent and Demart and so, but there's also been a debate going on with respect to the slowdown, be it what we see in the urban and the rural side as well. Are there not any, because yes, we do note the kind of opportunity size that we have for both of these companies to grow, maybe in the urban and the rural markets, but are you not witnessing, are you not concerned about any of the slowdowns trickling in the segments that these companies cater to?
The slowdown is real, Shrishti, right? There's no comment about it. The Q3 numbers which have come out so far have been positive. We have had a positive tinge to them, whether it be Reliance, whether it be DMart, Jubilant, and so on. The primary reason that everyone is attributing is to the festive recovery. I agree that 2025 as a calendar year is going to be tough for consumer companies from earnings perspective. The slowdown is going to affect them, especially H1 is going to be bad. We do not expect uh, the consumer demand to pick up materially in H2. Rate cut and budget incentives are two external triggers which can help trickle down more discretionary income for consumers and hence increase the spend. However, given the developments in the last 4 weeks, we expect the rate cuts to be muted and delayed. In light of that, the earnings for most of the companies I think have already been cut, and which is why the share fall is largely because of earnings cut versus multiple re-rating. So we are concerned about a slowdown, but in consumer, especially like I said, in structural stocks, we would advise investors to look for stocks which have great execution and longer term potential with stable management, because then that sort of makes you look for good price entry points versus saying what's the next 3 quarter return or next 3 month return. So demand slowdown real will lead to EPS fall and margin compression. We are more hopeful that better Rabi crop and hence a reduced inflation should allow for more cuts in the latter half of the year, which should then lead a slight demand recovery in the urban areas as well towards the H2 of calendar year 25. But H1 is going to be tough.
All right, Jignanshu, really appreciate your time and thank you for joining us. We've really covered a range of topics from pizzas to vada pav to Zudio to Demart. Kuch rah hi nahi gaya. So really appreciate your time. Thank you for joining us.